So let's do a little mortgage primer right quick. Government insured means this. If you take out a VA loan for $150,000 and you get foreclosed on, and the government takes the bank takes the house, Bank of America has a VA loan on you, Countrywide has a VA loan on you, and Countrywide forecloses on you, and they sell the house that has $150,000 owed on it, and it only brings, well, on a VA loan they wouldn't sell it. On a VA loan, what happens is as soon as they foreclose, they call the Veterans Administration, VA, and VA sends them a check for the loan balance plus all the late fees plus the interest rates. So Countrywide takes a loss on that foreclosure of exactly zero. They deed the house over to the Veterans Administration. You and I, the taxpayers, are now the owners of that house. And that house is then sold. If it sells for $140,000 and Countrywide got $152,432 to cover all their expenses, then the federal government takes a loss on the loan. And in that loss is the Veterans Administration's budget, and in that loss is the funding fee that funds the pool to cover the losses. So it's a federal government-insured loan, just like a student loan, a Sallie Mae. It's a federally insured loan, meaning the bank is taking no risk by making the loan. An FHA is issued through the Department of Housing and Urban Development, through HUD, and it's the same thing, basically. HUD insures the loan for Countrywide or Bank of America or whoever the mortgage company is. If you do not pay and they foreclose on, the mortgage company loses $0. They get 100% of what was loaned, plus all the fees, foreclosure fees, lawyer fees, title fees, late fees, interest rate fees, bankruptcy fees, any kind of fees that they paid out. They get 100% coverage. They take zero risk. And the federal government covers that loan 100%. And so the banks love making VA loans, and they love making FHA loans. However, VA and FHA have figured out a long time ago they have to cover a lot of these costs, and they put fees in there to cover all those costs. Fannie Mae is much more of an open market traditional mortgage in that a bank is making a loan and they're taking a risk. And if you don't pay, they could lose money when they foreclose. They could lose money on that house. And so that's why they make you buy PMI, private mortgage insurance, that covers the first 20% of the sale price if you don't put down at least 20%. And because that covers them down to an 80% loan-to-value ratio, and so a $200,000 house, surely they can get $160,000 out of it, and surely they can get their money back. And that's the way they look at it. But that's a bank making a loan with some private insurance, not federal. The federal government is not involved in that transaction. And it ends up being less expensive because guess what? Those loans fail less often. And FHA and VA loans, the VA loan was originally brought up as one of the benefits to our fine veterans. I just had the pleasure of meeting a World War II veteran a few minutes ago here in the lobby. And, the original thing is the VA, the Veterans Administration, was put in place to provide benefits to the veterans. Sometimes it does a good job of that. Most of the time it doesn't. The VA benefits are not really that good. I mean, when your only benefit for buying a house as a veteran is the most expensive way to buy a house, that's not exactly a great benefit. Didn't do a good job of that, right? And so it should be cheaper for veterans. That would be the idea, and not more expensive. Philosophically it should be. Not necessarily mathematically, not necessarily government policy or any of that crap, but just philosophically, if you want to be a blessing to the veterans, don't charge them more than they could get the house for without using the VA. Duh. It's kind of basic in my mind, but they do. So that's it. And the VA will chase you after foreclosure for the amount they lose on you if you're a veteran. That's just really oxymoronic, but they will. They'll chase you harder than anybody else will. FHA completely forgives the deficit. They don't chase you. The Veterans Administration will chase their own people and chase them down and get the money out of their hide, man. It's brutal. We work with this stuff all the time after the fact of the foreclosures. So we get to see both ends of it, both sides of it, and that's how you see it done. Conforming mortgage, while we're doing our little mortgage primer here, means in any one of those three cases, those loans conform to a set of underwriting standards. FHA loans have exactly the same process for approval. If you violate one step of the process for approval, it cannot be an FHA loan, and you lose your government insurance. Same thing with the VA. It follows an exact process, different, but an exact process to be approved. Same thing with the Fannie Mae. It all conform. All Fannie Mae loans are just alike. And so you could take for instance, it wouldn't work exactly this way, but you package them together and they're sold as a security. Fannie Mae Bonds. You may have heard your grandmother buying a Fannie Mae Bond. Well, all that is four $250,000 mortgages put together that are all just alike because they are conforming, and then they sell them as a $1 million bond. And so you package it together. So that's how they sell the mortgages on the secondary market, how your mortgage gets sold to a different bank all the time. You're always wondering how you end up with a different bank? They're packaging these loans together because they're all just alike. They're conforming to the same underwriting guidelines, so they're very marketable. This is the Dave Ramsey Show.